Today, Wall Street's winter freeze. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the temperatures in the US are set to tumble, driven by a significant Arctic blast, leading to perhaps the coldest Christmas day on record. And Wall Street came out in sympathy, reversing the anemic gains from the last couple of days, during which the talk of the Santa rally was again on, although I had my doubts. And again, trade volumes were lower than trend, with 10.88 billion shares changing hands compared to 11.24 billion averaged over the last 20 days. And weirdly, it was the good news is bad news syndrome again, because data again underscored the likelihood the Fed will continue to lift rates into a recession. Indeed, Wall Street's major averages closed lower on Thursday, with technology-heavy Nasdaq's 2% drop leading losses as investors worried that data showing a resilient economy would indeed lead the US Federal Reserve to keep hiking interest rates for longer than feared. The final estimate of the third quarter US gross domestic product was for 3.2% annualized growth. That's above the previous estimate of 2.9%. And meanwhile, the Labour Department said filings for state unemployment benefits rose to 216,000 last week, but were below economist estimates for 222,000. The job market, meanwhile, remains tight as initial jobless claims fell less than expected. The labour market remains very tight, Jeffries said in the note. We expect that it will soften eventually, but it is starting from a very significant position of strength, and it will take a little while longer for the cracks to form. And a third report showed the Conference Board's leading indicator, a gauge of future US economic activity, fell for a ninth straight month in November. We're moving past one of the big worries of 2022, which was the Federal Reserve's response to high inflationary pressure, to the worry about 2023, which is a recession unfolding in the United States and probably globally too, said Matt Stuckley, Senior Portfolio Manager for Equities at Northwestern Mutual Wealth Management Company. Today's data, to my mind, kind of confirmed this is the direction we're heading, said Stuckley, adding that high inflation, a bad economy and tight job markets should lead investors to come to grips with reality that earnings estimates are too high for 2023. Micron Technology's glum forecast added to the downbeat mood and caused the semiconductor index to sharply underperform the broader market for its biggest daily decline in over a month. Micron itself finished down 3.4%. While the chip maker's outlook for the fiscal second quarter was soft, Deutsche Bank says there is a risk for more downside as Micron's estimates point to a demand recovery towards the middle of the calendar year 23, which seems, quote, optimistic. Losses in rate-sensitive growth stocks saw technology and consumer discretionary indices the hardest hit among the S&P 500's 11 industry sectors. So the Dow Jones Industrial Average fell 1.05% to 33,027. The S&P 500 lost 1.45% to 3,822, and the Nasdaq Composite dropped 2.18% to 10,476. Recession fears related to the Fed's prolonged interest hiking cycle have weighed heavily on equities this year, with the benchmark S&P 500 on track for a 19.8% annual drop, which will be its biggest since the 2008 financial crisis. Strong economic data, especially strong labour market data, keeps the Fed's foot on the economic brake, said Liz Ann Saunders, Chief Investment Strategist at Charles Schwab, who would prefer to see economic weakness hit sooner rather than later, because then it gives the Fed the ability to pause. You increase the risk of an overshoot if they continue to be aggressive, because then the hit will be bigger, she said. Before it pauses, the Fed is expected to look for more weakness in the labour market and the economy in order to bring inflation down and to keep it down sustainably. The Philadelphia's semiconductor index closed down 4.3% after falling as much as 6% earlier in the session. Lam Research, a Micron equipment supplier, closed down 8.7% after leading the sector's declines throughout the day. Tesla shares plunged 8.9% after the electric vehicle maker doubled its discount offering on models in the US this month, amid concerns over softening demand. The luxury electric car maker started offering $7,500 discounts on Model 3 and Model Y vehicles delivered in the US this month, fueling concerns the company is facing softening demand as economies slow. In fact, on December the 1st, Tesla started offering a $3,750 credit on Model 3 and Model Y vehicles delivered before the end of the year, and it raised the credit to $7,500 on Wednesday. It also recently started offering free supercharging for 10,000 miles for vehicles delivered in December. The rare discounts follow a series of price hikes over the past couple of years by Tesla, who blames supply chain disruption and inflation. Shares of Tesla skidded as much as 11.1%, heading for their worst month ever as worries grow over softening demand for electric vehicles and Chief Executive Elon Musk's distraction with Twitter, which is purchased in October, of course. Tesla has underperformed the broader market, which fell as data showed a resilient economy fueled worries over the Federal Reserve's path to hiking interest rates. Analysts have reduced their estimates for Tesla's vehicle deliveries for the current quarter, reflecting slowing growth in key markets like the US and China. The fact they seem to be cutting price to increase delivery volumes doesn't raise confidence, particularly at a time when we see increasing competition, Craig Irwin, a senior analyst at Roth Capital Partners, said. As the US government plans to introduce tax credits to spur EV demand starting in January, Tesla customers had held off purchases until the incentives take effect, weighing on demand. The latest discount came just days after the US Treasury Department delayed restrictions on EV incentives until March, meaning Tesla and other US-made electric vehicles will likely qualify for the full $7,500 in incentives starting in January. And Tesla is also offering a $5,000 credit in Canada on Model 3 and Model Y vehicles delivered before the end of the year. The automaker has also given a discount of 6,000 yuan or $860 on some models in China to the end of 2022. Tesla said back in October it would miss its vehicle delivery target this year, but downplayed concerns about demand after its revenue missed Wall Street estimates. Elsewhere, CarMax sank 3.7% after the used vehicles retailer paused share buybacks after an 86% quarterly profit plunge. And AMC Entertainment Holdings shares slumped 7.4% after the world's largest cinema chain said it would raise $110 million through a preferred stock sale. So coming up against Christmas, we see the markets in a weak mood, and I suspect we're going to see this spill over into the new year for the obvious reason the Fed still has more upside risk, particularly on those rates. And of course, that puts downside risk in terms of recessionary pressures. And as I keep underscoring, I think that estimates of future earnings contained in the stock markets across the world at the moment, and particularly in the US, are overstated relative to reality. The question to me is, when does that reality dawn? Because when it does, stocks will probably go further south. Today, it's Edwin's Monday evening property rant. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.